Hey guys, how's it going? My name is Jeff. Welcome to the channel. Today I want to teach you about an invisible force that is silently taking money out of your investment account. Once you get to the end of this video, you are going to understand something new about investing that you didn't understand before. Now, the main thing you have to understand here is the idea of AUM, which is assets under management. And this is how all of the financial companies, all of the brokerage firms, everybody makes money off of you and me and other small retail investors. So the idea is they're basically marketing machines, okay? They make a whole bunch of different ETFs, and then they see which ones have the best returns and they promote those. And then the ones that have lousy returns, they usually kill those off. But what really matters to them is that your money is invested in their ETFs. ARKK, you guys know about this. It's the ARKK Innovation ETF. I think most everybody has heard about this. And you know, this fund has gotten in the news a lot. It got a lot of press because a couple or 3 years ago, it was generating really high returns and billions of dollars flowed into that ETF because everyone wanted to get rich. And they thought that Cathy Wood and her team had some kind of a formula that was somehow like this Midas touch. Everything they touched turned to gold. But the reality is things have come back down to earth, and the billions of dollars of investor money that was chasing those returns has flown out the door. There is still $7.34 billion invested in her ETF, in the ARKK ETF. Now, the 5-year returns for that are negative 9%. So if you risked your money and put it in there for 5 years, you lost money in that ETF, okay? And the expense ratio is 0.75%. That means, sure, you're only paying 75 cents per 100, but let's say you had $10,000. Now you're spending $75 every year for them to lose money for you. Over the course of 10 years, now you're paying $750 to a company like that. And that's money that could be in your account compounding year after year after year. And instead, this is going to pay Cathy Wood and the people who work at that fund company to lose money for you. Let's look at ETF number 2, okay? ETF number 2 is YYY, which is Amplify High Income ETF, and they charge 2.72%. So, you know, this is to me just insane. That means that over a 10-year period, you'd be spending $2,720 for them to manage your money. This ETF, they have $341 million invested. There are that many people with that much money investing, going after this high income ETF. This particular ETF over 5 years has lost 38.45%, all right? Minus 38.45. Compare that again to the S&P 500. That has returned 55.57. So again, I'm just using this as an example. The number 3 ETF is VMOT, VMOT. The Alpha Architect Value Momentum Trend ETF. That's a hell of a long name for an ETF that is not doing very well at all. They charge 2.84%, all right? That is an amazing amount of money. Again, 10 years out, if you had $10,000 invested, you would be spending $2,840 to be invested in this ETF. And the return, what kind of return do you get? Negative 25.30% over the last 5 years, okay? You could have had 55% with the S&P. People get greedy, they go after returns, they pay huge fees, and they lose money. You pay the same high fee whether they make money or lose money for you. It is definitely a heads they win, tails you lose approach to investing. Now let's look at the number 4 ETF, VICE, which is the Advisor Shares VICE ETF. The expense ratio on this is 1.64%. And you might think, well, that's a lot better than the other few that we've talked about here. But you know, this is an interesting ETF. It's called the Vice ETF. It's because the fund management company invests, I just read the prospectus this morning, in companies that are involved in tobacco, alcohol, and gambling. Those are the main themes, you know, people's vices. So I have to say this fund has done a little bit better than the other three we've talked about, because Vice has actually returned a positive 8.6% over the last 5 years, which is a pretty lousy return when you consider you get 55.57 with the S&P 500, but I'm just sharing the information. And the number 5 ETF in this list is AMZA, which also charges 1.64%, and that is the InfraCap Active MLP ETF. It has lost, it is negative 56.14%, and they have $307 million of assets under management. So they are making this huge management fee over $307 million. People who are investing in these funds, and they're hoping that they are going to make more money. They've lost 56% over the last 5 years. You know that little number, that ER, expense ratio? That's a percent. And it looks really harmless, right? At 0.5 or 0.75 or 1.5 or whatever. Let me tell you how this works. Let's just, for simplicity's sake, talk about a 1% expense ratio. What that means is every $100 invested in an ETF, $1 of that goes to the company running the ETF. So then if you have $1,000, then that turns into $10. And if you have $10,000 in this account, which a lot of you are going to have a lot more than that once you've been investing, then you're paying $100 every year just for them to manage that money. So even though it just seems like 1%, it's not too bad, over the course of, say, the next 10 years, you're going to be paying $1,000. $1,000 for them to manage your money. Compare this to a very low-cost fund like Vanguard's VOO or VTI. In those, you would be paying $3 for $10,000 managed. I mean, that is cheap. That's less than a mocha, and you basically have them managing $10,000. Compare that to, you know, spending $100. It's not even close. So let's take a look here. Your fees that you pay are their salaries. That is how they make their money. And your goal should be to keep as much of that money that you earn from your investing in stocks through these ETFs, keep it in your account. So Jack Bogle was 100% correct when he said that costs matter. Let's just say that the gross return that's created by American business is 8%. What you and I get to keep is the net return after the insanely high cost of financial intermediation. And what that means is once you've paid for marketing costs, trading costs, taxes, these expense ratios that go to ETF companies, we get to keep, say, the 6% that's left. But you don't have to pay that. It's just crazy because we put up 100% of the capital and then we take 100% of the risk. But in the end, you're only taking home 30% of what you could have taken home if you hadn't been charged those really high fees. Here's one other thing he said, just keep this in mind. He said, what happens in the fund business is the magic of compound returns is overwhelmed by the tyranny of compounding cost. He said it's a mathematical fact and there's no getting around it. All that money in fees, those hundreds of dollars that I was talking about earlier, all of this money that's now no longer in your account. It's in the fund company, the ETF company. It's in their accounts. It's been paid to their people. They're getting rich off of you. But if they stayed in your account, you would have hundreds and hundreds of dollars, maybe thousands, and that would be growing in time. So not only are you losing the $750, you are losing the compounding effects that could grow. The fact that we don't look at it is too bad for us, Bogle said. So I hope that this video has helped. And if you're not yet subscribed, I talk about investing, new ETFs that I've noticed that I think are worth taking a look at. I want to help you guys grow and learn as much as you can about investing. If you liked this video, you might want to check out this one below. It's my video about 5 ETFs for successful investors. It's my most viewed video on this channel. Other people have liked it, and I think you will too. So thank you guys for watching, and most important, make it a great day.